Welcome to True Path Finance Australia, where we explain money in simple terms to help you understand your options. Today, we're going to look at possible ways homeowners are managing rising debt, and specifically, whether rolling credit card debt into your home loan is actually a smart move or a costly mistake. Before we begin, this video is for general information only and does not constitute personal financial advice. It does not take into account your objectives, financial situation, or needs. You should consider seeking independent professional advice before making any financial decisions. A lot of Australians are asking this right now. You've got credit cards at 18 to 20%, your mortgage is around 6%, so it feels like an easy win. Lower rate, lower repayments, problem solved, right? Not always. On the surface, it makes sense. You reduce your monthly repayments. You move from a high interest rate to a lower one, and you get breathing room in your cash flow. But what most people miss is what happens over time. When you roll short-term debt into a home loan, you're not just reducing the rate, you're stretching the debt over 20 to 30 years. That's where the real cost can explode. Let's break it down with a simple example. A $20,000 credit card at around 20%, paid off over 3 years, might cost you about $9,000 in interest. Now roll that same $20,000 into your mortgage at 6% over 30 years. You could end up paying around $25,000 in interest. That's nearly triple. So yes, your monthly repayment might drop, but your total cost can go up significantly. You're trading short-term relief for long-term cost. There are situations where it can work, but only if you're disciplined. You need to aggressively pay down that portion of the loan, close or reduce your credit cards, and have a clear plan to repay it within 3 to 5 years. Otherwise, the risk increases. Here's what usually happens. People only make minimum repayments, they start using their credit cards again, and now they've got both the mortgage and new debt. That's how people fall further behind. Another key risk: credit card debt is unsecured. But once you roll it into your home loan, it's now secured against your property. Meaning your home is now tied to that debt. Now let's talk about something even more important: refinancing your entire loan back to 30 years. This is one of the biggest mistakes people make. Let's say you've got $500,000 left on your loan with 25 years remaining. If you refinance and reset back to 30 years, your repayments might go down, but you could add tens of thousands in extra interest over time. Because interest is calculated over time. The longer the loan, the more interest you pay, even at a lower rate. If you do refinance, a smarter approach could be, keep your repayments the same, avoid resetting the full term where possible, and use tools like an offset account to reduce interest. That's how you actually benefit long term. Before making any move, ask yourself, what's my plan to repay this? Will I actually close or reduce the debt? And most importantly, am I better off in 1, 3, and 5 years? Debt consolidation can help, but only when it's part of a clear plan. Otherwise, it can turn a short-term problem into a long-term financial setback. This content is provided for general information only and does not constitute personal financial advice. True Path Finance Australia exists to help Australians understand how the financial system works, in plain English. If you found this helpful, consider subscribing for more general education like this.